Hello everyone and welcome to This Week in the Markets. This week the US Department of Labor released its November non-farm payroll report, and it was quite a bit better than the market consensus. The Fed announced that it will expand the QE3 program by another $45 billion and set an explicit economic target of when it will rein in on monetary policies. And the Italian Prime Minister surprisingly announced that he will resign after the passage of the 2013 budget. And we'll discuss the implication of this news after going through our disclaimer. So information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regards to your objectives, financial situation, and needs. So analysts overestimated the effect of Hurricane Sandy in November's non-farm payroll report, as there were apparently 146,000 jobs being created last month, as opposed to the 85,000 expected. While this is positive news, we also have to take the first estimate of the non-farm payroll with a grain of salt, because the non-farm payroll are generally subject to multiple and large revisions. For example, October's non-farm payroll initially reported 171,000 jobs being created, but was later revised downwards to 138,000. The unemployment rate also surprised analysts as it fell 0.2% last month to 7.7%. This is the lowest it has been since 2008. The unemployment rate and the non-farm payroll are calculated using two very different surveys, but the report of 122,000 jobs gained for November was in line with the non-farm payroll report. However, one of the biggest factors contributing to this sharp drop in the unemployment rate was the increase of 350,000 discouraged workers who stopped looking for jobs, which means that the labor force shrank. The unemployment rate is calculated by taking the percentage of those employed to those in the labor force, so if people drop out of the labor force, the unemployment rate would naturally decline. So obviously this does not necessarily mean the economy has improved. Overall, however, we think that although the jobs numbers were not as positive as it first appears, it is still in line with the stabilizing of jobs and slow growth in the economy that we have been seeing the past few months. And the Federal Reserve announced on Wednesday that it will expand the QE3 program by another $45 billion each month to buy long-dated treasuries and to replace the Operation Twist program, which is due to expire at the end of the year. This was widely expected by market participants, but what was surprising was that the Fed omitted the calendar date for when it expects to make its first rate increase, which was formally at mid-2015. And instead, its guidance is now linked to specific economic threshold, namely the unemployment rate to fall below 6.5% and inflation rate to rise above 2.5%. Bernanke has previously said that the Fed will continue on with loose monetary policies until the unemployment rate falls substantially. But this is the first time the Fed has actually issued an exact target as guidance. It is also interesting that the Fed has set the inflation target at 2.5%, because according to their statement of longer-run goals and policy strategy, the Fed usually targets 2% for long-term inflation, so to be setting a target at 2.5% suggests that the Federal Reserve Committee is desperate to spur out inflation in the economy. Furthermore, the Fed's decision to set a target on unemployment rate is slightly controversial because arguably this is not something that the Fed has much control of, and even with the 3 rounds of quantitative easing, unemployment rate is still at quite an elevated level. There is also the risk that the economy enters a stagflation period where economic growth slows but inflation rate is high. And if the Fed targets both the unemployment and the inflation rate, it might be slow or even refuses to curb inflation, and the consequence may be a hyperinflationary scenario. Of course, this is not our best case scenario, at least not in the short and medium term, but it seems like the Fed, out of its desperation, is skewing the risk towards an inflationary environment in hope to avoid deflation. For traders, a few of the ways to take advantage of increased inflation expectations include buying non-cyclical stocks such as utilities and healthcare sectors, which have more ability to raise prices, or one could also buy gold or other commodities which generally holds quite well in real value, and also to short long-dated US Treasuries. Currently, we have not seen a surge in inflation expectation yet after the announcement. Partly this is because the Fed's actions were mostly expected and also because traders are unsure how much compromise would be reached for the fiscal cliff. If little compromise is made and the fiscal cliff could end up getting cut, there's more spending cuts being made and increasing more tax than expected. That could play down on the economy and inflation expectations. Nonetheless, as mentioned earlier, we think that the Fed is creating a risk environment that is skewed towards more inflation rather than less, and that would be the direction that we will take our trades in the medium and long term. In Europe, the Italian Prime Minister Mario Monti said unexpectedly that he would resign after the passage of the 2013 budget, and a new election could be held in February. Under Monti's leadership, Italy has successfully implemented many austerity measures and has helped to stabilize and restore confidence in the country's ability to honor its debt. So obviously, Italy is in a state of confusion after this announcement, and uncertainty has caused an initial knee-jerk reaction and brought equities lower in Italy and other parts of the Eurozone. Frankly, we are not experts in politics, let alone Italian politics, so for a situation like this, we let the market tell us what the expert consensus is. And for this, we examine the 10-year Italian bond yields and the CDS spread. If there is fear that Italy might not be able to honor its debt, we would expect bond yields to go up to compensate for the extra risk. As we can see in this chart of the Italy's 10-year bond yields, there was an initial jump on the announcement, but yields have fallen since then, and is still much lower than where they have been for the whole year. Similarly, if we look at the CDS spread, which we could think of as insurance premium on the likelihood of Italy defaulting on its bond, the cost of this insurance is still lower than where it had been earlier in the year. So for now at least, it seems like the market consensus is that the status quo will continue, and we should see the debt crisis in Europe stabilizing slowly. And that's all for this week in the market. Until next week, on behalf of the Trading Pursuits team, we wish you all profitable trading.